Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In yesterday's lesson we gave an introduction to fundamental analysis with a look at the U.S. economy and the top-down approach to analysis. In today's lesson we're going to further our discussion by taking a look at each of the pieces that make up the U.S. economy and how these are relevant to us as traders of the stock, futures, and or forex markets. So let's get started.
Okay, the first component of any economy is its natural resources. One of the key factors that allowed the United States to grow so quickly and become one of the world powers is that it's a land that's rich in natural resources, from oil, which drives our industry, our cars, and heats our homes, to lumbers, which builds those homes, to large coastlines, Great Lakes, and rivers, which provide shipping access and move goods throughout the country. Understanding the natural resources or which natural resources are more important to a country, and understanding what affects the supply and demand for those natural resources is beneficial not only to commodities traders who actually trade the physical or the futures contract for the natural resources such as oil or gold, but also to the stock and forex markets. We're going to go into these correlations in more detail in later lessons, but a short example here is that the United States relies heavily on oil. So when the price of oil goes higher, this normally is seen as negative for the U.S. economy, as it then costs more for companies to ship their goods around the country or overseas or whatever it may be, and for individuals to fill up their tanks of gas, leaving them with less money to spend. Similarly, as the U.S. imports much of its oil, when the price of oil goes up, this means more dollars are being sold and converted into currencies of the countries which are exporting the oil to the U.S., therefore all else being equal, weakening the U.S. dollar and strengthening the currency of the exporting country. And it's not really too important for you to understand all the correlations in the FX market and all this stuff. I don't want to confuse things. I'm just giving a couple of short examples here. We're going to go into these things in much more detail in later lessons. The important thing to understand now is that the natural resources of an economy are a very important component of that economy and very relevant from a trading standpoint, and are going to move markets. All right. The next component of any economy is its labor force, or the individuals who are working in that economy to produce the goods and services from that country's natural resources. As the labor force in an economy gets paid for their labor and then spends that money on goods and services that they and other components of the labor force have produced, they're an important driver of growth in the economy as well. The components which are watched in regards to the labor force are the size of the labor force, the growth rate of that labor force, okay, so how fast it's growing, the productivity of that labor force, in other words, how much time and resources it takes to make different goods and produce different goods and services, and the skill level of that labor force, in other words, how educated they are, or how good they are at certain crafts and those types of things, and then the mobility of that excuse me, of that labor force, which is basically their ability to adapt and change to changing labor market conditions. One of the key reasons, or another key reason why the United States has the largest economy in the world, is the size of its labor force is constantly growing and has been since the country was founded, allowing the economy to produce and sell more goods and services. Secondly, it's a relatively mobile labor force, meaning that the labor force adapts to change well, which has allowed it to increase productivity faster than other nations through things such as early adoption of new technology. It's also a very educated labor force on a relative basis. Okay, so why is this important from a trading standpoint? Here again, we're going to go into more detail on this when we look at important economic numbers and things such as this. But a short example is if the labor force becomes more productive, okay, as just one example, This means that they're able to produce more goods in the same amount of time. This not only makes companies more profitable, but it holds down prices for the consumer, giving them more money to spend on other goods and services, which drives growth, which means higher stock market, okay, which means potentially greater demand for commodities such as lumber and oil and these types of things as growth increases throughout the economy. And this higher productivity also has interest rate implications, which can affect the value of the U.S. dollar. And this is just one example of how just one of those components can affect all three markets that we look at: the stock, commodities, and the foreign exchange market. And again here, not important to understand, this part of it. I'm just throwing this in there as a quick example. The two things that it's important to understand from this lesson at this stage is that natural resources and the labor force are two very important parts of the economy. And as we go through in later lessons and look at some of the numbers which gauge growth and things, some of the things that we've looked at, you have a better understanding of exactly how these things affect the market. Okay, so that's our lesson for today. In tomorrow's lesson, we're going to look at the second two pieces of the economy, which are the private enterprise and government, and the role that each of these play. So we hope to see you in that lesson. As always, if you have any questions or comments, please leave them in the comment section below. And good luck with your trading.